900. Well, let's get into that conversation with Keiran Witthuhn, who's a portfolio manager at Robert Cohen Investments, as he helps us wrap up the week. Keiran, thank you so much for your time. So the last time you and I spoke, we were trying to make sense of everything that we saw from April 2nd and obviously market reaction. Let's look back at the month of April, because if you had fallen asleep at the beginning of the month and had a look at the markets, you would have seen a particular number. Fallen asleep throughout Liberation Day, the walk back and everything else that have come, and then woken up, you would have thought nothing happened in April. So help me make sense of the month of April as you see it.
Yeah, good to be Anastasia. And like you've said, it was actually quite a flat month in April, but it was the most up and down month I've ever seen in my short career thus far. And yeah, it started with the big tariff announcement, I think far worse than people expected. And then it was the markets sort of digesting that tariff announcement. And the word uncertainty has definitely been the word of the year so far. So that's what was largely the narrative at the start of April. But then at the back end of April, I think Trump was starting to walk back the tariff threat, shall we say, a bit. And the market was a bit relieved by this reprieve. And I think we've seen also decent earnings start to come out of the US. But yeah, there's been a lot of short-term noise at the moment. So I think a lot of people sitting on their hands, not the worst thing to do at the moment, but a very topsy-turvy month. And I think all our clients will be happy that it didn't deteriorate further after March. Is
that what you guys are doing, sitting on your hands until you can get a read on things?
Yes, I mean, we have been lucky in quite a lot of our funds and in a lot of our portfolios. We have had large levels of cash that we have been deploying. Maybe slightly contrarian in the US, but we also are upweighting emerging markets. But I think sitting on your hands in times like this definitely is the correct strategy. We don't want to be caught doing stuff that we maybe are going to regret in a few months' time. So I think, yeah, looking back, I think we handled the month quite well. And I think clients also sort of understood that, you know, look past the short-term news headlines.
Let's unpack that. I like contrarian on the show, especially when it comes to people who have still a really great constructive view on the US at a time where there are these changing perceptions around how people look at the US. What is the conviction or that's allowing you to believe that perhaps we can still continue our call for the US? What are you seeing underneath that we may not be seeing?
Yeah, so I think if you just look at overall sort of positioning with hedge funds and investors across the world, especially in the US, is that equity positioning is actually still quite light in the US. And we think that that valuation unwind has happened to a large extent. And then what we've seen really from this week of earnings, most of the Mag 7 having reported, is that this trend of AI really is, we think, actually going to still be driving the US market beyond the short term. I know I've been saying this for a long time. The tariffs have been a big headwind, but I think we've seen that the Trump put is sort of there, and he is actually sensitive to a big market sell-off. But overall, I think this week has just shown that the secular trend of artificial intelligence is going to keep on driving the market forward. And if you want to catch the tailwinds of that trend, you need to be invested in the US.
When the tech stocks reported last, Trump had just started his second term. And at the time, the main conversation was around how a lot of the AI CapEx was going to translate into profits. What were you guys listening out for when it comes to these earnings calls? Was it the AI CapEx and where it's going, or was it how they're viewing tariffs and what were they saying?
Definitely both of those, Nastasia. I think it's been hard for companies to give certain guidance in this earnings season. So whilst the backward-looking numbers have been quite strong for a lot of the companies, a few of them have had troubled guidance, Apple being the one. But I don't think we're going to place much weight on guidance that is so uncertain. But where it is more interesting is listening to how management are practically grappling with these tariffs. Amazon and Apple are two ones where we expect tariffs to have a larger impact than the rest. So it's been interesting to see how they plan to do that. A few of them, I think, will be cozying up to Trump a bit because politics is intertwined with their operations going forward. And then the AI spend, they've been doubling down, really, is what we've seen. We saw Meta and Microsoft actually increase their CapEx guidance for artificial intelligence spend this year. And I think that is just, I think the winners are going to continue winning. And like I think, yeah, the theme I would take from this week is that doubling down on artificial intelligence, and we see that as bullish. I think as long as the companies and their management remain bullish, we as investors need to follow the management and what they are guiding in terms of putting their money where their mouth is, which is continuing to spend in artificial intelligence.
Which is quite a refreshing view, because when we started earnings season, we had Delta, which pulled guidance. And in a conversation I had with an analyst, he said it was quite worrying that a lot of the companies would be pulling guidance or widening it. Yeah. Now you have this other narrative that's come into play where analysts are saying, actually, I'm happy that you're pulling guidance because you're not willing to put your head on the block and then get it wrong and then have the market punishing you for promising something you couldn't deliver. Yeah. You're okay with the fact that they're pulling guidance or widening it because most companies don't have visibility.
Exactly. I think it's fully reasonable what management are doing. To remain credible, you need to give accurate guidance going forward. And if you're not certain of that guidance, of course you're going to widen your range. And I think that uncertainty has been quite well communicated by management across the board. And Nastasia, if politics change in a week's time, I mean, I can't predict that. I can't predict what's going to happen in the White House. But I do think that I mean, we've been buying throughout the month of April. I think if you buy, you'll be pretty happy that you bought in a year's time. And I think it's important to just extend your time horizon beyond the short term, which is what we have really been trying to focus on. And I think you can't really position portfolios too much on short-term politics. I do think sanity will prevail to a large extent. And it's Trump's aggressive negotiating style is tough for investors, but ultimately trying to look past that.
Okay. What are you buying in the US?
So this is it's not US, but stuff like Ferrari we've been buying. Okay. Spotify is still expensive, but we've been looking to enter Spotify. There's a company listed in the US called Nubank. I've discussed it on the show before. Those sort of companies really have sold off quite significantly. And then we've been topping up NVIDIA, Meta, because we think those are going to be key winners in the artificial intelligence race.
That's absolutely fascinating. So we've gotten, you know, a lot of the data come through, and one has been obviously the soft data, which we've all been sort of discussing, soft versus hard data. When do things, you know, take a turn? We were hoping that, well, not really hoping, that sounds quite bad, but we were trying to see when it came to the GDP figures whether we'd see the first signs of it. Yeah. It's a mixed one. I can't really make a clear conviction. When you look ahead and you try to anticipate what's coming, are you expecting that soft data to try to translate into the hard data in the third quarter? Where are you starting to see things probably take a turn in the US?
So, Nastasia, I think that we've seen quite weak backward-looking data from the GDP announcement that came out on Wednesday. I think that is largely from the tariffs. I think there's a combination there. The US economy has been slowing for a few months, but I think the tariff seems to be hitting growth before inflation. I think it's going to hit both. I think it's going to decrease growth as well as increase in inflation. I think both in the short run. So we are expecting the next few months of data to not be so strong, but the stock market is a leading indicator. I think that has been pretty much all priced in, unless there's huge negative shocks to the downside. We actually are quite constructive on the second half of the year. We do think that things are going to start improving in the US, and a lot of commentators and the sort of narrative as well as the data is showing a very similar pattern to what we saw during COVID. And if you recall, that was pretty much a V-shaped recovery, and it was also largely driven by uncertainty. So there's a lot of parallels to be drawn to that. And based on the current facts that we know today, we are seeing a stronger second half in the US, which should then translate to the rest of the world.
Does that translation also include South Africa? And if so, which sectors are you and the team at Anchor sort of discussing quite loudly in anticipation of that second half?
Yeah, so it definitely will influence South Africa. I think South Africa's had quite a positive last 2 months, actually, because of what's happening in the US. The US dollar has weakened significantly, and that helps emerging markets. We've seen assets flow into China, to Europe, into South Africa, despite what's happening at home. So we don't normally make calls based on macro in the local market, like obviously gold has had a very strong year, and we are still hesitant to upweight it further, given how far it has run. It can really change quickly. But we're still holding on to our quality investment thesis style in South Africa. Companies that are growing in an economy that is not growing, I don't think we can rely on economic growth to lift up SA equities this year. So it's companies like We Buy Cars, ShopRite, those sort of companies, Capitec, that are able to grow or gain market share, because I don't think South Africa, despite what happens in the US, I don't think we're going to have the tailwind of high economic growth this year. But obviously our market is sensitive to the rand, so we could see some rand strength continuing.
When you look at some of the earnings that we've gone this far, whether it's the SA guys or the guys in the US, what do the balance sheets look like coming into the earnings season?
In the US, the balance sheets have been quite strong, and that is a reason that we still like the US. I mean, if you just look at the amount of cash that those top tech companies have on their balance sheets, they can weather any storm for a few quarters, and they'll be fine. South African balance sheets, I think, also in a decent shape, but obviously the commodities have had a few years of low prices, especially the PGMs. So that is not a sector that we'd be touching at the moment, and we saw the news out of Murray and Roberts. So I think having a troubled balance sheet when times get a bit tough is something I would urge investors to be cautious about.
Keiran, let's leave it there. Thank you so much for your time. That was Keiran Witthuhn, who's a portfolio manager at Robert Cowen Investments, joining us in studio. We're going to take a quick break. When we come back, we'll have more for you, so stay tuned.